Good morning, ladies and gentlemen. I hope I'm audible clearly. Perfect. So, over the course of the next 10 minutes, I'll take you through a topic on which a lot has been spoken about, yet a lot remains to be told. So, we're going to be talking about the electric vehicle ecosystem. Before that, let me introduce myself. I'm Pushan Sharma. I take care of automobile and agriculture research at CRISIL. And what we will be discussing today is we'll start off with the global landscape, what various countries are doing when it comes to their EV targets. And then it's very important to look at not just what the vehicle level penetration is going to be, right? It becomes important to see how the ecosystem is likely to develop in terms of the battery demand, its pricing, charging infrastructure, range anxiety, something that is associated with electric vehicles. So how is the charging infrastructure expected to evolve at the state level? Very critically, competition from CNG, right? Because that's something that not a lot of us are talking about, but we believe CNG is going to give electric vehicles a run for its money. We'll then talk about electric vehicles in terms of their penetration at a segment level and some aspects to watch out for. So over the course of the next 9 to 10 minutes, I'll take you through maybe a lot of data, but my job would be to leave you with some insights as we peer through the data, right? So if you look at various countries, they have steep targets, when it comes to electric vehicle penetration. Just give me a second. Just give me a second. Let me just pull out the laser pointer. Yeah. So if we talk about the North American region, Canada, by 2025, they want about 20% of zero emission vehicles going to about 100% by 2040. In Europe, Belgium looks at about 20% zero emission vehicles by 2025, going to about 100% by 2050. Neighboring countries, Spain, as well as Netherlands, their targets also are similar of about 100% zero emission vehicles by 2050. Closer home, in Asia, China has a target of 40% electric vehicles by 2030, India about 30%, and Japan seems to be having the most stringent, or I would say, they've set a target which is aspirational in terms of 100% carbon neutral car production itself by 2050. So that's how the global landscape looks like. Now let's look at the most, I would say, important ingredient in an electric vehicle, batteries, which comprise nearly about 40-45% of the cost of the vehicle. Now, what we're trying to show here is how is the battery demand, right? Energy demand is going to be how it was in 2020 and how it's likely to be by 2030. What you can see here is that about 50% of the demand in 2020 from the battery side, energy side, came from consumer electronics. That is expected to shrink to as low as 6%. Whereas transportation, that which stood around 27%, less than one third, that's going to go up to 63%. And that's going to be enabled by this rapid movement that we're expected to see across vehicle segments towards EVs. Now, if we look at the energy demand in GWH, gigawatt hour, by the vehicle category, today in fiscal 22, the year gone by, e-rickshaws dominated the demand on the energy side because we see significant penetration. 40% of the energy demand coming from e-rickshaws. That's going to shrink over the next 10 years to only about 3%. Two-wheelers, which account for about 1/4 of the energy demand today, that's going to occupy about half the energy demand. Whereas cars will be from 1/5, they will go to about 35% of energy demand. Right, so clearly energy demand is shifting towards the transportation side. Now, while this shift happens, what do we expect on the battery prices, right? Today, by 2021, in terms of USD per kilowatt hour, battery costs are around $250. That's 2021. We expect that to go closer to about $200, and I'm talking about NMC batteries here, $200 by 2027, and by 2031, 2032, we're expecting that to be about $175 dollars per kilowatt hour. And that's going to be a function of localization. That's going to be a function of the PLI schemes, where we've seen companies bid for about 130 gigawatt hour. A lot of these schemes require localization. In our base case assumption, we've taken about 35% localization for the component supplies on the battery side. And all of that is going to bring about this reduction in prices, which, by the way, saw an increase through the pandemic because of the supply chain issues that we saw. Now, today we are reliant heavily on imports for our battery needs. All of our battery requirements are imported, right? How does the situation change with the addition of these battery manufacturing facilities in India? So what you see here on top are the additions in each year that we're expecting on the battery side. So if you see in the first half of the forecast horizon, that is till 27, the additions are going to be minimal, and it's going to pick up pace from fiscal 27 onwards. 27 onwards, we're going to see close to 100 gigawatt hour of battery additions happening, and that's where we believe a lot of the traction on electric vehicles will start to happen. Further, what you see on this chart is the demand, which is indicated by this blue bar here, and the production locally for the energy. So if we look about at 27, we see that the demand is around 40 gigawatt hour, and we're not going to be requiring a large chunk of that demand will still be met through imports. As the electric vehicle penetration picks up, this import percentage, which used to be about 100%, went down to about 34%. That will inch up again to about 45%. So only 55% of India's battery demand will be met locally over the next 10 years. And some of the largest plants that will be set up, like Ola and Reliance put together, they're coming up with a capacity of about 90 gigawatt hour. That will be closer to the end of this decade, around 2030. Now, having spoken about battery ecosystem, let's look at what happens on the charging infrastructure. We're expecting about 30,000 EV charging stations to be set up over the next 10 years. And states which have a higher urban population, those are the states that will dominate the charging infrastructure. So what we've done here on the map is color-coded the states in reducing colors, from going from dark to light. That shows the intensity of the charging stations. So states like Maharashtra, UP, Karnataka, Gujarat, they are expected to have a higher number of charging stations by virtue of the population as well as the urban centers there, followed by states like Tamil Nadu, Bihar, Andhra Pradesh, and Madhya Pradesh. And these 8 states will account for a chunk of these 30,000 EV charging. More than 50% will be coming from these 8 states itself. Another thing about EVs is, a lot of us wonder as to, is our power demand or power supply sufficient to meet this demand that's going to come from electric vehicle in terms of their energy need? What our analysis shows is that at an overall level, by 2032, only about 3% of the total power demand is going to be consumed by electric vehicles. So while that sounds quite less, but if you look at the story in a slightly different manner, if you cut the data in a slightly different manner, if you look at the incremental power demand, so if power demand goes from 100 to 120, out of that, 60%, more than 60% of that incremental power demand comes from electric vehicles. So clearly, while the rest of the sectors are going to grow, say, about the real GDP growth of about 5 to 7%, EVs in that same period of time is going to clock a CAGR of around 40% thereabout, and which is what is going to lead to this sharp increase in the incremental power demand coming in from the electric vehicles. Now, having spoken about what the global landscape looks like, battery demand, localization, as well as charging infrastructure, now let's step into what does this really mean for the vehicle level penetration. And I'll take an example of two-wheelers to begin with. And what you see on this chart here is the two-wheeler demand agnostic of the fuel type. So for a customer, they're looking for the best fit vehicle for them. They're not looking at whether it's petrol, diesel, or CNG, or an electric, whatever suits their needs at an economic point which is favorable, that's what they're looking for. So this is agnostic of fuel type. What is the total two-wheeler demand? And what we see here is that in fiscal 12, we were selling about 13.4 million units of two-wheelers. In fiscal 22, the number is still close by, right? So in 10 years, the industry is almost flat. We're still at about 13.7. And what the chart further shows you is the breakup of motorcycle versus scooters. We can see that the share of motorcycles has come down from 75 to 66%, while scooters has increased from 19 to 31%. So motorcycles, in fact, has seen a negative 1% CAGR over the last 10 years, and scooters has seen a 5% CAGR. We believe over the next 10 years, we're expecting to grow by about 8% CAGR for the total two-wheeler industry, where scooter outpaces motorcycles, growing by about 11%, and motorcycles at about 7%. And this has been done through an econometric modeling and adjusted for factors outside the model. Now, having looked at what the overall lay of the land looks like for two-wheelers, now let us look at what the electric vehicle story is likely to look at. I'll not go into the details of the chart here, but what I want to leave you with is, if you look at these two charts, the first one is for the total cost of ownership. So if I own the asset, how much do I spend on it annually, versus this is the cost of acquisition. So if I try to purchase this asset, what is the money that I need to shell out to purchase? In India, cost of acquisition is a very important one. Not a lot of buyers really look at total cost of ownership unless it is a B2B transaction. Two-wheelers definitely is not. But what we see is there is a compelling case here to actually look at total cost of ownership. On top here, you have the internal combustion engine vehicles. One of the most selling ones like Pulsar, Activa, Splendor, and Tork. And here you have the electric vehicles like Ola S1, Revolt, Okinawa. And what you see is that the mouth of this chart opens up as we go along. And what that indicates is that the total cost of ownership keeps going down for these vehicles. And that's because, as you saw in the previous slide, the battery prices are declining, right? And if you talk about the total cost of acquisition, it's favorable across multiple electric vehicles today. But you would see that this inches up by fiscal 25. And that is because the FAME subsidy goes away. With the FAME subsidy going away, we see a temporary increase in the cost of acquisition for electric vehicles, and that will start reducing in a couple of years with the economies of scale and lower battery prices. What this does not factor in is the PLI benefits. Companies will also extend the PLI benefits that they are getting from the government, and that can further bring this down. But even today, even without that, what we see, if we combine cost of ownership and cost of acquisition, it makes sense to buy an electric two-wheeler today. And which is why we believe that we are expecting a lot of traction from the two-wheeler side. In the interest of time, I'm not going to the details of all of these vehicle segments. We've done a similar analysis for all of these vehicle segments. But what I've summarized here is across asset classes, how does the total cost of ownership and the cost of acquisition look like across the 10-year period? And what one can see is that in case of two-wheelers, the total cost of ownership remains favorable right from today till 2032. And even the cost of acquisition remains favorable, going into the neutral zone once the FAME subsidy moves away. But coming back, three-wheelers, again, it makes sense from a total cost of ownership perspective. One can't say that about cars, where it becomes favorable only in the second half of the forecast horizon. That is from fiscal 27 onwards towards 32. That's where it might make more sense for an average car buyer to go for an electric vehicle. And in case of the light commercial vehicles, it remains largely unfavorable through and through. In terms of the electric vehicle penetration, we believe that two-wheelers and three-wheelers are going to lead the pack in terms of their EV penetration. We're expecting about 20 to 24% coming from two-wheelers in terms of annual sales by 27, going up to 55% by 32. Slightly more aggressive numbers on three-wheelers, about 30-33% by fiscal 27, going to about 60-64% by fiscal 32. In case of cars, little lesser than that, 6 to 9% by 27, going to about 25% by 2032. Now, one aspect that needs to, be spoken about a lot more is what really happens while all of this is happening on the EV side. One needs to monitor the CNG story closely. And the reason why I say that, and I want to draw your attention here to the data points that you see here in blue. And these show the CNG stations. Over 5 years, that is from fiscal 15 to 20, we added only 1,000 CNG stations. But the number doubled just in a span of 2 years. From fiscal 20 to 22, the 2,200 CNG stations went to about 4,500. And that is, you would also correlate that with the sales that you're seeing on the vehicle side where CNG has really picked up, right? Interestingly, this number is expected to double in the next 5 years. From 4,500, it's going to be upwards of 9,000, and then double again, as per the government plans, to about 18,000 by fiscal 32. And more interestingly, what's there is that the spread of the stations is going to be quite good across states. because the share of top 10 states by fiscal 20 was as high as 94%. So it was extremely concentrated. That is going to go down to about 50%. That means the spread of these incremental stations is going to be pan-India. What does that mean for the waiting time of vehicles? Today we're at about 2,000 vehicles per station. That's going to go down to about 700. So waiting time is going to go down, and the global average is about 1,000 vehicles per station. So we're going to be in a good spot when it comes to CNG, and that's why we believe that they are going to compete very well with the electric vehicles. In case of cars, we're expecting about 30% of cars to have CNGs. In case of three-wheelers, the number shoots up by 27, going to 60%, and comes down to about 35%. And in case of light commercial vehicles, we're expecting about 40% of the sales by 32 to come from CNG. Some of the aspects to watch out for. So, we're done discussing most of the data and details around electric vehicles. But in terms of the geopolitics, we believe that there will be a shift. Our dependence on some of the nations where we were dependent on crude oil for, that's going to change, because the lithium ion reserves and much of the mineral reserves are concentrated in Australia and Africa. China, for example, it has some of the reserves on its own. Whichever it doesn't, it's actually making strategic investments in some of the African nations. And India really needs to catch up on this, because our dependence on China as well as Africa and Australia is going to increase for the mineral reserves. And for anode and cathode, our dependence again goes to Europe and China. So this, on a geopolitical side, is an extremely important aspect to monitor. So I've given you a snippet of what this entire research report talks about. More details are available in our detailed report, which talks about the global landscape, battery ecosystem, charging infrastructure, and the vehicle level demand by state. So we've split the demand at the state level for the next 5 years and 10 years, and what it means for the auto component industry, as well as the financing opportunity and all of those aspects. And in case you have any queries, I'll be in the room and I'll be happy to answer your queries. So thank you so much for your patient listening. Thanks a lot.